Welcome to the Intermarket Analysis update, where I go over a number of different areas, and there are some changes this week. Typically, what will happen is I do this video week after week, and there's not many things that change, but there are some changes this week, and it's actually looking more positive for the market overall. This is being prepared for Monday, June 30th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first area that I'll go through is valuation, historical, as well as looking forward. Then I look at growth versus value, and this is where we're seeing some of the improvements taking place. We also will keep an eye on inflation, which doesn't seem to really be a problem, at least right now. And then we look at other markets that we usually don't follow that closely, just to see if we can get any insight that way. I go through the 11 sectors that make up the S&P 500 and then compare them to the S&P. We look at some main indexes and correlations between different areas of the market. Then we look at some long-term trends, and then I finish off by going through a list of those things that are positive and negative. The first area is valuation, and this is historical looking back. We use a static level of 10, 15, and 20 using the PE ratio, the price to earnings ratio. And when we're above the red dashed line, we're considered to be expensive on a historical basis. And we are, and we have been now for a number of years. And to break that out a little bit more, I have the difference between the price of the S&P, which just set an all-time high on Friday, and the PE ratio of 20, which again, we would still have to fall to about the 4,200 level just to be considered expensive. This looks at that same thing, but goes all the way back to 1980 with different events that have happened along the way. Then there's a kind of a different twist on looking at previous earnings to current price. That was developed by Robert Shiller. He uses a more smoothed approach, using earnings over a 10-year period of time and takes an average of those. The current reading is coming in at 37.65. All right, you can see it's pretty high up here on the chart, going all the way back to the 1800s. It's also more than double of the median and the mean. It's between 16 and 17. So yes, we have more confirmation that stocks are expensive, but they've been expensive for quite a while. The market looks forward, and even this is looking expensive. When we look at the Mega Cap 8 here, and there's the Magnificent 7, and there's different groups that you can put these into. But the purple line here, we're coming in at 29. That is really high. But we have been higher than this before. We got up over the 38 mark there for a while when things were really coming up out of the COVID plunge. But this is considered to be expensive. The red line is the S&P itself, coming in at 21.9. It's above that 20 level, so that's considered expensive. And improving this past week have been the mid caps and the small caps, with the mid caps coming in at 15.9 and the small caps at 15.2. That's more fairly priced. Then this is another way to look at this. What are PE ratios around the globe? And you have the US, at least at the time this chart was made, we were at 21.5. We're actually a little higher than that now. That's way above this range that we typically would be in, and more expensive than any other way you measure it across the world. Then growth and value. Now we are seeing a real improvement with growth. We just generated a recent golden cross here. We're setting a new all-time high with the pure growth index. And it's not like value is falling apart. It's just underperforming right now. It's still in a downtrend, but we see prices above both of the moving averages. Where we get the insight is when we do ratios between the two. And this is looking pretty strong now. Growth versus value here really breaking out. And then an inverse of that same chart, because sometimes we get a little different perspective. This shows how value is underperforming growth. And then I look at a number of different charts to see, are we getting confirmation by looking at different types of instruments and then different time frames. So we look at a growth versus value ETF. This is looking good, but not back to an all-time high yet with this ratio. This also is an inverse showing how value continues to underperform growth. We've been seeing that for a while now. We look at some growth to value indexes. This is where we're seeing a new all-time high. And then this is continuing to go down, showing how value is underperforming. This I show in the daily videos. This is a growth versus value ETF, not breaking out to a new high yet, but still looking pretty solid. Then value is underperforming growth here, another confirmation. The small caps, not really breaking out, but still holding up quite strong with their growth to value ratio, and also looking pretty good with mid cap growth to value, and improving, but not breaking out to a high yet with the S&P growth to value ratio after generating a recent golden cross. Then this is kind of interesting. I ran across this throughout the week, and I showed this in the daily video, and I wanted to show it here. If you look at the growth to value ratios for the S&P, that really is going up, okay? And then when you look at the value to growth ratio in the US, it's really going down. This just means that the US has been really focused on growth versus value outperforming, where the rest of the world has been focusing on value outperforming growth. So it's kind of, that's why we have been seeing, at least for about the first half of 2025, the US markets have been underperforming, especially the European markets and actually global markets as well. If we can get into a more positive stance, setting more new all-time highs, having a good summer, we will see the US market start to come back in and show an improvement as far as performance. Then inflation, ticking up a little bit here with the monthly chart of inflation versus deflation. We're above the moving average. We'll keep an eye on that. And then we are above an advancing moving average with the monthly chart of the CRB Index. Now, this will complete after Monday because June will be finished, and we'll see if anything new is written for next week's video. And we look at the Baltic Dry Index, which is still basically in a downtrend. It started to spike up as geopolitical things were unfolding, and now it's been coming back, but it's still in an uptrend overall. We look at the CRB Index, which really took a hit this past week, but it's hanging on barely to an uptrend here on the daily charts. Inflation expectations still kind of coming up after they had been going down earlier in 2025, but not really breaking to the upside. And we look at inflation expectations to TIPS, which are Treasury inflation protected securities, are actually coming down a little bit. Folks are tending to prefer TIPS over inflation expectations. So we're not really getting much insight here from this chart. And some other markets, aluminum continues to be in a downtrend. Corn is in a downtrend. Well, it's actually in an uptrend, but really pulling back. Wheat continues to be in a downtrend. Fertilizer, it was really going up. It came down a little bit, now it's starting to go back up just a little bit here, but not necessarily inflationary. Lumber is just barely hanging on to an uptrend. Oil, which spiked up into the high 70s during the geopolitical events a week ago, it's now fallen back to the mid 60s. And then the gold to oil ratio, gold has just been going sideways to slightly lower, and gold's been flying around all over the place. So we've been seeing this ratio coming back up slightly. And we look at the relationship between oil, the red dashed line, and the 10-year yield. They're actually having a tendency to go in the same direction, which lately, even though these charts have been going up, for the most part, we've been seeing a real big drop off here. And gas is barely hanging on to an uptrend as folks are getting ready to do some summer traveling. And then heating oil did really spike up, but now really came back down. It was down 3.5% in Friday's session. Natural gas still in a kind of a lazy uptrend there. And then we really started to spike up with diesel a week ago. Now it's been starting to come back down. Copper is in an uptrend. We're seeing this on the weekly chart too. This is a barometer of the economy. And when copper is doing better, that means the copper market anyway is anticipating the economy doing well going forward. And the copper to gold ratio really spiked up here. Now, copper's been underperforming for quite some time, but gold has been going sideways to down. Copper was up strong. That's why we saw a real spike in this ratio. In longer term, the short-term spike that we're seeing, but in the bigger picture, the copper to gold ratio is continuing to decline as interest rates have pretty much been going sideways. And gold, here's where we're actually dropping below the 50-day moving average. Now, this is the ETF, not the futures contract. And we're just kind of chopping around, but still looking a little more positive with silver. The dollar continues to be negative, both on the daily chart here and on the weekly chart. And the euro is going up with the dollar going down. And we're kind of going sideways here, a little bit of strength still with the Japanese yen in an uptrend compared to the dollar. The euro's in an uptrend as the dollar's been under pressure lately. So you can see where the euro just really going up compared to the dollar, kind of going sideways, but still in an uptrend with the Japanese yen. And the British pound has really been going up compared to the US dollar as well. And we've really been coming down with the gold to silver ratio. Gold has been seeing a bit of a pullback where silver's been holding up a little bit better. And then the dollar's been going down. And so we're seeing this ratio going down. And there's a fairly high correlation between the top chart and the middle chart. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at some indexes. I did show this off and on throughout the week in the daily videos. We've been going up with the weighted version of the S&P. We're improving, but still lagging behind with the equal weight version of the S&P 500. And this is just an inverse of that, pretty much that same thing. When this is going down, that means the equal weight is underperforming the weighted version of the S&P. And we look at stocks to commodities, and stocks have been coming on strong here. Still in a downtrend, but really improving. Here's an inverse of that same thing, showing how commodities in the shorter term, since we've been coming up out of the lows in April, this ratio has been going down. And then the NASDAQ 100 is outperforming the S&P 500. Now, we've got both of them setting new all-time highs. The NASDAQ 100 did it a few times this past week with the S&P 500 setting a new all-time high on Friday. They both can be doing really well, but it's more positive when this ratio is going up to see that the NASDAQ 100 is outperforming the S&P 500. The S&P 100 is continuing to outperform the S&P 500. Those are the bigger stocks. And the NASDAQ is outperforming the S&P, and we're seeing a golden cross here with this ratio. This is where we're seeing some of the strength coming from. The big stocks are doing well, but the NASDAQ is doing well also. And so this ratio going up is more positive for the market. And you can see here, the NASDAQ 100 is actually underperforming the NASDAQ itself, even though the NASDAQ 100 is doing well all on its own. Mega cap growth setting a new all-time high here, generating a recent golden cross. That's big. These are the really big stocks. And then the mega caps compared to the S&P 500 equal weight, that's not at an all-time high yet, but really showing some strength as of late. Small caps continue to underperform the S&P, even though small caps had a pretty good week. And this red line is the ratio between small caps and the S&P. The blue line is the S&P 500, showing the divergence that we've been seeing for a while now. The robotics and AI ETF breaking out a little bit above the rainbow and actually coming back up a little bit, but still in the bigger picture is underperforming the tech sector on a ratio basis. The Dow Jones Composite Average improving, but still in a downtrend. And this is the Dow, the transports, and the utilities together. Low volatility ETF, it's holding up. A lot of sideways action here, where we're seeing growth going up. The more defensive areas, which they call low volatility, that's just pretty much going sideways. And we really notice this when we do a ratio of the low volatility ETF to the S&P. When this is going down, that means the low volatility ETF is underperforming, and that's more positive for the market. All world, now this are all of the stocks, taking out the U.S. stocks. So this still continues to be an early solid uptrend, just setting a new all-time high. Not really improving all that much, but showing some slight improvement here when we put the U.S. stocks back into the ratio. Then energy sector, really, it was up a week ago, That was the spike up that we saw. And then as things seem to have unfolded as planned in Iran, we're seeing this ratio really coming down as tech is outperforming energy. And tech is really starting to show some strength when compared to the 10-year yield, and the 10-year yield is starting to underperform when compared to the tech sector. Growth is outperforming bonds based on price. This ratio is looking pretty positive. Discretionary improving, but not showing any real strength yet when compared to staples. Staples underperforming lately, but there's a lot of damage as the discretionary sector has been under pressure. Then gold really pulling back when compared to the S&P. It's because the S&P is going up as gold has been going sideways to down. Not much of a change here with the gold to US dollar ratio though. And small caps continue to underperform the tech sector. Then looking at the advanced decline line, this is looking pretty positive across the board. We're above the moving averages with all the major indexes. And then we're going up with the Dow here, but we're not necessarily seeing that in a convergence kind of way with the transports. They're improving, but the Dow has been doing better than the transports, and the utilities are still holding up okay and just kind of drifting higher for the most part, but not really breaking down either. And then when this ratio is going down, that means the transports are outperforming. When this is going up, that means the Dow is outperforming the transports. Seeing a lot of choppiness right now. The transport's trying to break out here, but has some previous highs and previous resistance levels that it needs to break through to show more promise there. And the transports continue to underperform the S&P, but the correlation between the two still remains fairly strong. And then we switch out Dow theory. Instead of using the Dow, we use the S&P, which is setting an all-time high. The NASDAQ, which set an all-time high on Friday. That's a positive confirmation. Where we see a bit of a negative divergence here is we have not made an all-time high with the equal weight. We didn't set an all-time high in February either when the S&P did. The last all-time high here was set back in 2024 with the equal weight S&P. If this can keep going up and improve and set a new all-time high, that would mean there's more broad participation in the up move, where we are improving with the equal weight version of the Qs, but we have not set an all-time high there yet either. The FANG index, these are the big stocks, is setting another new all-time high and in an uptrend. The Wilshire is improving, and I think this is an all-time high here on a closing basis. And we are improving with the total U.S. stock ETF. So we are seeing some broader participation. ARK is in an uptrend both on the daily chart here and on the weekly side after really suffering for a number of years. The NYSE composite just generating a golden cross here and just barely setting a new all-time high on Friday. All stocks setting all-time highs. This is U.S. and international stocks. They're also in an uptrend. High leverage loans. This is another barometer of the economy. Doing really well here, setting all-time highs. Emerging markets are in an uptrend. Japanese Nikkei, it's above this red line, but it's really been chopping sideways for quite a while. And Bitcoin continues to be in an uptrend. Microcaps in a downtrend, but improving. Semiconductors just about ready to start generating golden crosses. And this was a stronger area of the market. And we're coming into a time in the first part of July seasonally where the NASDAQ, which includes semiconductors, tend to do well. And so this is looking a lot better with the SMH semiconductor ETF, just about ready to generate a golden cross. Looking better when we look at this same ETF breaking out of the rainbow. The AI and tech ETF setting a new all-time high and now in an uptrend. Then we look at the home builders and we look at the top chart, which is the S&P, the home builders in the middle. And we see that the correlation between the two is pretty strong. Home builders has still been really struggling, going back to the late part of 2024. Rolling over a bit longer term with the KST in China, we're still going down with the emerging markets, but it looks like we're trying to turn up here. Europe is still in a downtrend, as is Japan, and we still have the US. This is a very long-term oscillator, and on the daily side, it's still negative. So it's going to take a bit longer for this to actually show more improvement. Showing some improvement here with the US to global stocks here. We're still above the moving average. This is a monthly chart, and so it will actually complete when we finish June, but we're still going down with the momentum. Then looking at bonds based on price, even though they were down on Friday based on price, we're still showing some improvement here. The total bond ETF based on price is in an uptrend, and we'll complete this at the end of June as well. This is a monthly chart of the stock to bond ratio. It had really fallen down here and was causing some concerns, but has really been improving and getting really close, if not setting a new all-time high with this ratio. The Pring World Bond Index continues to be in an uptrend. Bonds continue to underperform stocks here on the daily chart and on the weekly chart as well. High yield bonds, junk bonds, setting all-time highs. Investment grade bonds improving, but just kind of chopping around lately, but they are in an uptrend. Corporate bonds just started to show some improvement and are starting into an uptrend. And the stock to bond correlation, stocks based on price, bonds based on price, fairly high correlated relationship. Tend to be going in the same direction at the same time. Riskier bonds to more conservative bonds, we're actually seeing this ratio coming down a little bit as stocks have been improving. Junk bonds just setting recent all-time highs and outperforming when we compare junk bonds to government bonds. This ratio continues to go up. Still setting that higher range with the 10-year yield after we had been seeing 40 years of declining yields. And here's the daily chart of the different index, different maturities here. We are declining for the most part, and that gave support to stocks. Weekly chart, not really seeing any big changes here when we look internationally. And look at the volatility of bonds. That's the MOVE index. As bond prices have been going up, volatility's been going down. The VIX has also been going down, and a fairly high correlation between the top chart measuring the volatility of bonds and the middle chart, which measures the volatility of stocks. And then looking at some ratios between stocks and bonds, this is still looking pretty healthy. We look at the S&P to 1 to 3 year bonds. You're going to see a lot of the same things here, a lot of improvements. The S&P 1500 to short-term bonds also improving. Another broad market measure with 3 to 7 year bonds above the rainbow. The tech sector doing quite well when compared to 3 to 7 year bonds. The S&P to the 10-year yield starting to improve, even though it's still in a downtrend. And then 3 to 7 year bonds, this is inverted of what we were just looking at, to stocks. This ratio is continuing to go down, and if we continue to go down, we'll eventually see a death cross here with this ratio. And then we look at the long-term price of the 30-year bond, still not showing an awful lot of strength. It's kind of chopping along here. And when we look at the ratio between the long-term bond and commodities, we're seeing where long-term bonds are underperforming. Then we look at the 11 sectors. Materials still dealing with a downtrend, having a difficult time getting above their 200-day moving average, and underperforming when we compare it to the S&P. Communication, a big growth area, setting an all-time high, and really looking pretty good, starting to kind of break out here on a ratio basis with the S&P. Energy, which was really up, and then it came back down, still in a downtrend, and underperforming when we compare it to the S&P. Financials doing fairly well here and in an uptrend when we look at the sector by itself. But this is where we've been seeing some concerns. With the ratio between the financial sector and the S&P, we came down to the 200-day moving average. So far, we're holding above that. We would like to see this ratio continue to go back up. And then industrials, they're looking pretty good and setting an all-time high and in an uptrend, and one of the better performing areas of the S&P. Tech sector setting an all-time high, just generating a golden cross with the 50 crossing above the 200-day moving average, and one of the better performing areas here when compared to the S&P. Then the staple sector just kind of going along sideways, not really breaking down, but not showing a lot of strength. And that's better. That we want to see the growth areas do better when we're more positive on the market. Staples underperforming the S&P, and that's more what we would see in a positive environment. Real estate just having a hard time here. In a downtrend, just kind of chopping around here. and underperforming and in a downtrend when compared to the S&P. Utilities still are tending to drift higher overall. Now, as I say quite often, utilities are generally considered to be defensive. Widows and orphans, that's what they get into. Safe, pay dividends. But you could also make a case that utilities are a growth area because of AI, because of all the Bitcoin and crypto mining that has to go on, electric vehicles, and all the need for electricity. You could say this is kind of a pseudo growth area right now and starting to underperform, but still in an uptrend when compared to the S&P. When this ratio is going up, that means the S&P is outperforming the utilities. And healthcare really having a hard time in a downtrend, dancing around its 50-day moving average and underperforming quite severely when compared to the S&P. Discretionary, not really breaking down, still in a downtrend. Had a good couple of days this last week, but we need to see this really going up. Last summer, almost a year ago in 2024, from about August until the end of the year, discretionary was the best performing area of the market. It'd be nice and it would really help the market if it could get back in that same kind of favor again and not really outperforming when compared to the S&P. Semiconductors, not quite at a golden cross yet, getting close, but really showing some strength here with the SOX ETF. And then the Dow Jones Semiconductors, seeing a golden cross here, setting an all-time high. Semi to tech ratio going up, that's positive. We see the semis going up and tech going up, the semis going up even stronger. Then the semiconductor to Dow ratio continues to improve, coming up closer to the blue line. Then here's the weekly chart. This is a 200-week moving average, and we're showing some strength, still having a ways to go to get back to an all-time high. Then looking at gold, which is seeing some drifting down, but it's still the best performing asset in 2025. Stocks are now in second place. We had oil in second place a week ago, but then it dropped down. That's the red line. Then the purple line are commodities, and then bonds based on price are the blue line, and then the dollar is still the most struggling asset in 2025. Correlations, we look at the S&P to the dollar, real strong tendency to go in opposite directions. The S&P has been going up as the dollar has been going down. S&P to oil, S&P has been going up, oil's now back to going down, opposite directions there. Also, the S&P to the 10-year yield, S&P has been going up as the 10-year yield's been coming down. We see the opposite correlation there. Same thing with the tech sector to the 10-year yield. It's been going up as interest rates have been coming down. And in the shorter term, the S&P has been going up as the 2-year yield has been coming down. Then some long-term charts here. The NYSE monthly chart, this is good. And we're setting an all-time high here, and we're above the moving average. And we're getting ready to close out another month. We're still negative, though, with the Copic curve. Now, if we can go up from here and show some improvement, eventually we'll see this momentum oscillator turn back up. And here's another monthly chart. Looking pretty good here and starting to come back up, but not showing as much strength here with the NYSE record high percent index. And showing some improvement with the S&P on the monthly chart, and we're above the moving average. So this is showing some real improvement. Then another monthly chart of the S&P, and then we do a stocks to commodities. Now, shorter term, stocks are starting to outperform commodities. Longer term, stocks are still underperforming commodities. Then another look at the S&P to global index here, still above the moving average, still going down with the KST. We're going to need to see more follow through to see the U.S. stock, anyway, as measured by the S&P 500, start to outperform global stocks. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then positive things now, and there's been some changes here. We have the growth, which is on the positive side. Copper is in an uptrend, as is the euro, the British pound, and the yen when compared to the dollar. CRB Index is in an uptrend. Gold and silver are still in uptrends, even though these gold has been pulling back. Silver has been holding up a little bit better. And then the low volatility ETF, when you look at it by itself, it's still in an uptrend. It's just underperforming when we compare it to the S&P. Mega caps, new addition to the list, showing some strength here. Tech sector, new addition to the list. Semiconductors. Now I have all of them on here. They're not quite all at golden crosses yet. That's kind of optimistic on my part. We'll have to see if it ends up playing out that way. Staples are still in an uptrend by themselves. They're just underperforming when we compare it to growth. And then bonds based on price. Corporate bonds are back over on the positive side. And we have the NASDAQ 100 and the NYSE. Those are new additions to the list as well on the positive side. The FANG index setting all-time highs. ARK in an uptrend. High leverage loans, emerging markets, all stocks, and Bitcoin. Those are all in uptrends. We still have the value in a downtrend when we look at the value index. And in a positive market, it will underperform. US dollar in a pretty severe downtrend. The Dow Jones Composite, which is the Dow that transports in the utilities. And then the Dow still in a downtrend. The NASDAQ, even though it's setting an all-time high, it hasn't generated a golden cross. Neither has the S&P yet, but we're getting close. Mid caps, small caps, and micro caps are still in downtrends. The Wilshire improving, as is the total US stock ETF. We're getting close, but we're not quite there yet. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.